We are live on LinkedIn and YouTube. Our topic today is what does the oil and gas industry need to remain competitive? This is Professor Cleveland Jones, researcher, member of Geoscience Advisory Board, international consultant to the oil industry. Welcome, Professor Cleveland Jones.
Nice to be with you again, Cavani, especially talking about the industry that I care so much about.
Yeah, yeah, important industry in the world,
Yeah.
no doubt. Professor Cleveland brought some slides, so after each slide, we can stop a little bit and try to see questions, comments, and my comments and questions too. Please go
Yeah,
ahead, Professor.
yeah.
Show the
I
slides.
just wanted to share some slides like an introduction. This is basically the situation for the oil and gas industry. Um, it's of course raking in big money last year, maybe some ups and downs, but it faces challenges because there is an uncertain future in oil prices, and of course that introduces risks, and even the high risk of the industry itself deter some of the very necessary investments to keep the industry going, keep a full pipeline, and so on. And then, of course, the industry itself deals with very large and very long duration projects. It's not like slam dunk. The projects require immense capital. And nowadays, we see that other energies are also competing for those dollars, even if the fossil industry begins to regain some importance. And of course, the exploration and development and production of frontier exploration plays is of strategic importance for many countries. The United States is quite well situated in terms of supply and demand. Certainly, the Middle East is a big producer, but the rest of the world has to strike some kind of a balance because they cannot remain very dependent on specific regions for their supply. So all of this, and the fact that the world still has many plays and exploration plays that are very attractive, but they're just not explored yet. Uh, those are the impediments to the progress. Maybe I can uh, exemplify
Yeah, sure, sure.
oil prices. This is long history of oil prices from the 70s. The first thing that jumps into your eyes is that they are volatile. They have been volatile over the recent past and certainly going back, and they will likely remain volatile, even though, I had argued, even in your programs, that we're more or less in a kind of a band in the last few years between 60, 70, and 90, and we go up and down, but have remained there. But look, if we look at inflation adjusted prices were extremely low even as recently as 10, 20 years ago, and we've had spikes very low. So this is a very big concern for oil industry. If prices go down, and if they remain down, if it's just a spike, no big deal. But if they remain down for an extended period, that can be a problem. And let me say this, there is some recent analysis of Trump's policies of imposing tariffs on China and many other countries that suggests that is actually a path that may bring down oil prices, which might be one of his objectives anyway, to get gasoline prices low in the U.S. But that would have a very depressing effect on oil and gas prices, and then the industry would have a tough time surviving that unless it adjusts accordingly.
So you mean that wars are not influencing oil price?
Um, so far they haven't, and you saw that even in the Ukraine war, gas prices spiked, but oil prices remain more or less. We've had the crisis in the Middle East, and prices have not
but
skyrocketed. In
but not
fact, they've
in a very short time as a spike, but
a very
just
short
after
time.
comes to the normal.
And this band that I've been talking about with you, even that we're more or less stuck there between the 70s and 80s, maybe a little bit above, maybe a little bit below. That has held for a good while. But you can't just extrapolate the last couple of years. And if you look further back, you see that there have been many times when oil prices were low and remain low for 10 years, 1990 to 2000. And other times they remain very high. But now we face a situation where if indeed, just like the Depression era in 1930s, high tariffs the United States imposed on many commodities and from everything from rubber to soybeans to coffee, the prices drop 70, 80, some cases 90%, because tariffs have a very perverse effect of isolating that production in those producing countries, and the overall price in the world comes down, and the industry has to survive that. Of course, the countries that were producing rubber and coffee and so on suffered tremendously, certainly not the U.S., which was on the import.
And renewables. Are renewables pressing oil price to go to the lower level?
I think people thought they would be. I think less so nowadays. I think that the real danger here, it's not that big a danger, but it's a certainly a reality, is that alternative energies, and not just renewables, will siphon off a big chunk of investment dollars that would otherwise be going to the oil and gas industry. So that is indeed a very strong influence on available capital to invest in oil and gas.
And do you see producers reducing themselves, the production that they have? So,
No.
I mean, no.
No, look at that. The OPEC is very worried about what it can do because it can't do too much. It can't cut production to keep prices up because they need the production, they need the revenue, and they saw that that is not very effective. And even nowadays, when they expected to, bring back their production, they just can't do those things. They don't have the power to do so. Look, in this, you see that the cycle is so big that once you have production going at the end of the pipeline, it tends to keep going because you're not going to shut off, an offshore production rig or in many cases onshore production. But that is the predicament that the oil and gas industry is in because you have these projects. Once you have production, maybe Saudi Arabia can move 1 million barrels up and down. Russia doesn't want to do that. It needs all the money it can. In most other countries, Iran and all countries in South America and Africa.
This flow is not for the discoveries just done. I mean, for pre-salt, for instance, we just have this exploration.
We've had this. This is, maybe 5, 7 years, some cases more, 10 years to get a project into production. This is not only a problem to put new projects into production, it's a legacy problem because nowadays, many of the projects that are now into the end of this cycle, they're not going to stop after 7 years of investment and all these things.
Yeah.
You can't put the brakes. So we're going to have some projects coming in. Maybe we won't have enough if demand keeps up, but it's a problem because you can't adjust this cycle very quickly. But it is a problem for the big producers outside the United States. I think the United States is quite well positioned.
For instance, equatorial margin, if we decide today that we will start this exploration process there, we will take 7 years to have the first oil at this place.
More. There it will take 10 years, even with technological improvements. That is a reality that you can't escape. Looking forward, we can try, and this is one of the things that I argue, that the oil and gas industry has to change. It cannot live with this. The beauty of some of the unconventional oil and gas projects in the shale patch, for example, is that it's very quick to turn on production and turn it off. That is fantastic. But, oil and gas companies need to keep a balance between conventional and unconventional resources. And as I've said in other programs, the unconventional production in the world is the United States. Everything else, forget it. Maybe China a little bit. It will not take off. So even though unconventionals are interesting in niche areas and so on, they will not play a significant role outside the United States. And they are the only projects that are short enough for the industry to be able to react in terms of prices. Produce more when the prices are high, reduce production when it's low.
Okay, perfect.
Let me say this. Going forward, we have to keep the pipeline full. You have to discover oil and get it into production. In the past, we've had a terrific fall in discoveries. World oil and gas demand combined is something like 60 to 70 billion barrels, 30, 40 billion in oil, maybe 25 or so in gas. But we're discovering an equivalent to 2, 3. And if you go back over a longer period, it's horrible. We're not replacing reserves. I've said this in your programs before. We don't need new reserves, but we need new discoveries to keep the industry active. And this is a trend that is, for over 10 years now, we're just absolutely falling short. So if the industry is as uncompetitive as it is now, because it can't afford to invest 10 times more to keep discoveries on a par with consumption, it has to think up a new way of operating.
So
This is a very dangerous trend over maybe 5 or 10 years.
So this chart shows that we are discovering more gas than liquids along the time.
Exactly, but
Why?
overall, we're discovering a tenth of what we're consuming in the world. So we're consuming 60 or 70, and we're discovering 5.
Okay.
We have plenty of resources, the Middle East, the US, Brazil, and so on. But when you don't replace new discoveries, you end up shrinking that first segment, the exploration side, because you don't have enough exploration and discoveries. So the industry becomes unbalanced.
Okay.
This is a concerning trend that has been going on for a long time. And as long as we had 10 years or 20 of very big discoveries, we could handle it. Maybe not into the future. Yeah. And this is the slide that I was mentioning. Investment dollars are being siphoned off by the renewables and the alternative energies. Eventually, maybe the oil and gas industry will recover in the U.S. Maybe less investment will go to renewables, more to oil and gas, maybe in the rest of the world. But still, even if it's even amounts going to each, the oil and gas industry hasn't been able to obtain more than half of the investment dollars available.
So we expect to have more investments in renewables, clean alternatives than fossil fuels. That's the message
Yes.
you have in this chart.
Yes, and we discussed before that that's the case, but that's not going to solve anything because big investments in renewables don't provide good results. They provide very little useful energy. So the realization has to come in that oil and gas needs more investment. People have to recognize that the solution is not just to invest as much in solar and wind, because that's not going to substitute oil and gas equally.
And we have petrochemical feedstock, and we have liquid,
which are forecast to continue being big demanders. Exactly. This is a reality that gives support to the need for the oil and gas industry to change, because you could say, well, they're making a lot of money, what's wrong? What's wrong is that you can't sit on your laurels. You have to look forward, and if you see dark clouds, buy an umbrella or something. So there are strategies that I want to discuss, because all of these things point to an oil and gas industry that may be making a significant amount of money, at least in the majors. But the oil and gas industry is also a lot of countries that some are less developed countries, some are developing countries, Brazil, some African countries, Mexico. There's Middle Eastern countries that have large production, but they're still aspiring to develop. Then there's China and India, who have big development plans and are short on oil and gas. They have to diversify their sources. So there's all kinds of pressures on the industry, and they have to come up with some strategies. The main one we mentioned before is going back to a focus on their core business, oil and gas.
Only a consideration. When you say remain competitive, competitive with what?
Competitive with prices, because if indeed these forecasts that are now beginning to be worked out among economists, not energy industry, just economists looking back at past effects of high tariffs in world trade. The result has been very low prices. If prices come down, like those charts that I showed, and remain low for 5 years, say, the oil industry will have to survive instead of just closing the doors. Because, you can't say, oh, gee, too bad, the oil prices are 25, 30, we can't make money, so we just shut off all the production. No, you have to remain competitive to exist and come back later, maybe. So there is a necessary competitiveness that needs to have low break-even prices to find ways to reduce risk so that they can continue to invest in projects that they know that they will be making money on, and to reduce those time frames of 10 years, because almost no industry going forward in this dynamic world can really survive the high risks involved with 10 years of project lifetimes. So I argue, yes, we have to go back to core business. Some companies, as we've discussed, are beginning to do that. They're de-emphasizing a little bit their renewables and so on. They still have to keep some investments in that, but the focus is on oil and gas. For sure, that's fine, but not oil and gas business as usual. They have to develop and adopt new technologies to reduce exploration risk, time to develop projects, and costs. And the key word here is adopt, because the oil and gas industry is very innovative, and it says on all of the major companies on their sites, they say, oh, we're innovative and we adopt new technologies, but they are very slow in adopting new technology.
It's for exploration, this second bullet.
No, look, it's across the board, and I'll show you how that works out. For example, even when you have a discovery, now you're going to start producing it. An FPSO takes 3, 4, 5 years to get into production, to build it.
I'm not seeing, for instance, carbon capture in your list. No,
I don't focus on that for the oil and gas industry. I think that is an important investment area in the economy, and it will take off. Even direct air capture and all of these crazy projects will become economical later on. But hey, it's not for the oil companies to have to do that. The decarbonization policies that they adopt is fine. And they may even include carbon capture and storage, pumping it into reservoirs and so on. But that is not key. The key to being competitive is to develop the oil and gas business, to make it effective, efficient, and low enough operating costs that they can survive ups and downs, especially downs in prices.
Focus. Yeah, you're right. Yeah.
So exploration, sure, because you have to keep the pipeline full. You can't just produce, because eventually you don't have anything to go back from. So you have to keep a full production across upstream, midstream, and downstream. And that is maybe more difficult done than said, because many companies are much more focused on discovering and developing, and maybe not so much into refining and so on. And case in point is Petrobras, which is not self-sufficient in fuels, for example. Even though they have a large crude production, they can't refine all of it, so they end up exporting a lot of crude and importing diesel.
Import from Russia, diesel, for instance.
But it is key to prioritize the plays that the oil and gas industry look at. Some programs ago, we mentioned that where are the new plays in the world? They have to be very selective. the Gulf of Mexico we mentioned because it's close to the U.S., controlled, safe, and prolific. Very little environmental concerns there, and very well known production parameters so that you can put large offshore facilities into production. Certainly the oil patch in the U.S., maybe Guyana, the Brazilian pre-salt, some niche plays in Africa, but very selective because it's not just the play is geologically very favorable, it's large, it has billions of barrels. It has to be safe. If it's in a country in Africa or Middle East where that is not the case, that is not a prime area for consideration because you have to look at the next 10, 20 years of production. And if it's safe now and it runs the risk of having revolutions like Syria from one day to the other, this happened, or from one month to the other.
But IBAMA doesn't mean that we can do it safely.
No, safe. I'm talking about geopolitical risks here because the geopolitical risks are really the concern for the oil and gas companies. If they get to license their projects, it's because environmental agencies in Brazil, the U.S., or Nigeria, they gave them the okay. That's fine. If they got the okay, they got the okay. But now they have to really also consider, is it very safe to operate in a country that has had various revolutions that can change the operating contracts, by decree, or there has a revolution, the new general comes in and says, now we nationalize this. This has not been a major problem recently, but you can't forget the past. This was a big problem, not only in Venezuela and other countries. And now with the geopolitical risks that we are facing across the world, this is a very pertinent question. Certainly, maybe Brazil is safe, Guyana is relatively safe, the Gulf of Mexico is safe, maybe Australia is safe. Is the Middle East safe? Maybe some countries, certainly less than we considered safe before. And the plays have to be durable and resilient because, if you have a very large play and the break even is $45 and the price comes down to 35 and stays there for a couple of years, what are you going to do? Suffer immense losses? So no project is going to be put in place, even at $70 oil prices or 90, unless the break even is very low. And this is the kind of discipline and responsibility that the oil and gas industry has to have when putting in new projects, because it has to put in very low break-even cost projects. Many countries in the Middle East, on economic grounds, because of their budgets, they have break-even prices of $70 and $80 a barrel. And some countries over 100, meaning that they're not going to have their economies balanced, their finances balanced. So this is an untenable situation, especially going forward and looking at possible risks of low prices lasting for over 1 or 2 years. Maybe it doesn't have to be 10 years of low prices, but 1 or 2 or more years of low prices can destroy an industry or certainly many companies. So the priorities are there. And of course, I mentioned that they have to balance conventional and unconventional.
But unconventional are growing so fast compared to conventional, no?
Yeah, that is an advantage of the companies that are involved currently in unconventional. Mostly that pertains to some U.S. companies and some foreign players investing in the U.S. But outside of the United States, Argentina is touted, but is still insignificant in unconventionals. And even looking forward 5 years, it will be less insignificant, but it's not going to mean much in terms of unconventionals. But the advantage is
Brazil is importing gas from unconventional Vaca Muerta.
But small amounts, and it may import more. But again, what Brazil imports is still very little in the big scheme of things. So, when you consider that the United States alone exports many times the overall consumption of Brazil, what Argentina exports, it's insignificant now. It's not going to be very important later. Maybe it will help Argentine finances, but in the big scheme of the oil and gas industry, it's not significant. And there isn't any country in the world, maybe China can press unconventionals to provide production because it believes that energy security is important. But since unconventionals, even in China, are very expensive, that is a very risky bet because those plays are up into the $80 and $90 range. And if prices come to 60 or even below, those plays are worthless. So it's very difficult to balance that. And of course, the United States has a very good situation because break-even costs in the shale patch are near 40, sometimes less. So they are going to be much more resilient. And the advantage of turning on the faucet or turning it off is very quick to respond to market signals, whereas most other countries don't have that alternative.
Okay.
So balancing conventionals and unconventionals is key. There's not much that we can suggest, to tell Shell and BP and Total and Equinor about that, other than them buying into shale plays and LNG plays from the U.S. because there aren't any plays outside the U.S. that are still available. But I do want to point out that in strict terms of technological developments and so on, there are a lot of things that happened in the last few years that really moved the needle in terms of technology. Certainly, the technologies involving standardization have lowered costs significantly. Even FPSOs, which are still billion and multi-billion dollar investments, they are less expensive than they would have been by far if we had not adopted, digital twins, artificial intelligence in designing them, and so on. Nowadays, it's not just engineers there on design boards, it's artificial intelligence designing the pumps. Where are they? The tubing and so on. This is unthinkable back then.
So many new technologies coming in.
Exactly. So this is an essential part of the new oil and gas industry. And like I said, they are innovative, but they're slow to pick that up. Even artificial intelligence has taken 2 or 3 years for them to really pick up the pace because a lot of other industries had already picked up the pace, automotive industry and so on. The oil and gas industry now is finally realizing that these multi-billion-dollar projects, you can shave off 20, 30% by intensive use of artificial intelligence in all segments of the project. And of course, there is a finance or economic side to it. Industry consolidation is likely a good strategy for a lot of smaller companies and for the big companies to still pick up more small companies. The bigger you are, the better you can survive.
We could include in this, add to this list, financial discipline. Maybe the last point you mentioned.
Yeah, that's what I was saying. The financial discipline is picking projects that might make a lot of sense because you say, oil prices are 70 and 80. This makes sense at 40 or 45. No, you have to be disciplined and say, we still will not approve any project unless the break even is below 40 or 35. And you have to have that kind of discipline. And for that reason, consolidation is important because there are many companies that have good areas that could become plays that could be developed by bigger players if they bought them up. But the smaller players themselves can't develop those plays. And this is across countries in Australia, Southeast Asia, even in South America, Colombia, certainly in Brazil and so on. We've seen that kind of consolidation, and we can see more of it because that strengthens the industry to face the challenges that they're going to be facing. Now, I told you that maybe I wasn't going to talk about specific technologies in part because I am involved in some myself. But remember, there used to be the saying that the best business in the world is running a well-managed oil company. The second best business is running a poorly managed oil company. Well, that's not true anymore. Nowadays, you have to manage a company well in order for it to do well. Forget this thing, oh, an oil company gives money like a cash cow. That's not the case. We have to have discipline, focus on the business and on new technologies that will make a difference. I put a couple things here. Um, these are themes. You know that in the beginning of the cycle of any project is exploration. Exploration is run by seismic. Seismic is king. Seismic is 8% of the expenditures in the exploration phase. That is untenable and it's not sustainable, and that has to change. And there are major technological changes coming that will be able to change that. And that is one of the big aspects where, exploration can absorb a lot of money in seismic. And if we can reduce that and time and risk and so on, that exploration side can become more competitive. And then
But
yeah,
but being replaced for what? Seismic. Seismic is
okay.
replaceable.
Well, it can. There are many non-seismic tools, not only grav and mag. The industry has been slow to use some of those because seismic is very good. I was at a recent presentation by PPSA, the Brazilian state company that handles contracts in the pre-salt, and they were showing some extremely good seismic that are, providing insights and information like never before. But despite these improvements, seismic is still expensive. When you do a 3D survey over a large area, that can quickly become prohibitive. And if you go to gravity technologies, like some that we're working on, stress field detection and so on, you can provide a different model for the exploration. Instead of finding out what the subsurface looks like, you find where are the accumulations, and then you look at what the subsurface looks like to develop that particular project. That can cut time, cost, and risk. But on the development side, there's also, of course, money is big here because once you've made a discovery, you have to do more development and so on. And the timelines and the equipment used, sometimes is an FPSO to advance production while other things are going. These things have to be rethought. FPSOs are tremendously expensive. And nowadays we are beginning to think of alternatives, seabed alternatives in some cases, where you can maybe, if not do away with the cost of eventual FPSOs, which are multi-billion-dollar investments, you can delay that for another phase and you can advance production. That is important. And of course, in production, production nowadays, especially offshore, is FPSOs. That's basically the world model. The U.S. was slow in adopting that, but even nowadays in the Gulf of Mexico, that's the direction that production is going. But even here, we see that there can be major changes, not just in standardization and design of FPSOs, but in the size to make them more economical and more efficient, lowering costs.
With a limitation. So growing size is not the solution itself.
Well, we used to have FPSOs 100 and some 120, then 150,000 barrels a day. And then we went to 180, and now we're talking 220 and maybe 250. These things are unimaginably big, but with big comes efficiency, lower cost. And in an industry that has to keep its break even low, as I suggest, under 40 and so on, if you need to go to a 250,000 barrel a day FPSO, that's the way to go. And especially if you standardize a lot of things, you can lower prices tremendously. There are some examples from a cost congress that I attended where just the specification of the materials for the FPSO provided something like 20% savings. because the standard procedure is, oh, we don't know how corrosive
Yeah.
the fluids are going to be.
Uh-huh.
Specify the best steel possible.
Uh,
10 times more expensive than anything
there's a
else.
point to add to the production side is the subsea bed. I mean, seabed
See,
processing is
yeah,
something that's growing very fast.
exactly. So this is what I'm saying. Instead of an FPSO, maybe we have to start thinking of everything down in the seabed. Already, many things from the FPSO topside already on the seabed, maybe more and more, and eventually almost do away with that. But there are specific technologies and companies involved in providing them. That's my business. But it's important for people to keep their eyes open for this, and this extends even to the end decommissioning phase. Nowadays we recognize that we have to set aside big bucks for decommissioning, but maybe we can rethink that if we, from the beginning, think how we are going to repurpose some of those installations
Yeah.
at the end. And if that's the case, maybe we can
Pe-
save a lot of money even in decommissioning.
Petrobras is doing in the campus basin this reconsideration, no?
Well, they're decommissioning a lot of installations because they've come into the 25, 30-year lifetime. Still, we're at the point where decommissioning basically means ripping out and taking, thousands of tons of steel into recycling
Very
and
big
so on,
problem. Yeah.
off-site, some, rigs to reefs. That requires
Yeah.
some environmental concerns, but that's possible. But we have to think this on a large scale. Decommissioning itself has to be thought of right from the beginning as something that will take less money to decommission, and maybe we can repurpose that for wind
Mhm.
farms, for whatever else, even hotels or anything else that
Yeah.
can use that and save a lot of money. And of course, like I've always said, technology is the key, is the solution to everything. We have to maximize digital technologies, artificial intelligence, machine learning. This is what's going to provide the answers to be able to bring break-even costs down to 35. Right now, that's going to be very difficult. Very few projects in the world have that kind of break-even. Maybe the pre-salt, because of lifting costs around $5, they can say, oh, we have break-evens like that, but very few in the world. And I would say even the Middle East does not have break-even costs in the 35. Nowadays, that is a problem for Saudi Arabia, Kuwait, and so on, that their facilities are producing at much higher costs than even they let on. Sure, they have giant production, so they still make money, but the days where break-even costs were dirt cheap, those are gone. So a lot of adjusting for the
Okay.
industry.
Mhm.
Your thoughts?
So the conclusion, you have one more item, no?
No, no,
No.
I think
Yeah.
this is the
This
path
is
forward.
this is enough. The conclusion could be that the oil industry will remain, let's say, attractive for the next 2, 3 decades without big challenges. That's your vision.
I think it will be. It will have to make these changes. It will have to adapt. Because if it just continues business as usual, of course not. So this is the thing. Everything is dynamic. Even the oil industry, making billions as it is now, will have to adjust, but it will because
and and this and this, to summarize, maybe costs, low costs, technologies, new technologies that are coming. What else?
safe operation.
Safe, strong, safe.
Safe means not just worker safety, means geopolitical safety, because
Geopolitical
you
safe.
can't dump $10 billion
But
like in
at,
satellite.
at the same time, a replaceable part of oil for petrochemical and fuels. So this is not replaceable. This is the big strongness that this industry has.
But you see, when we say, and I suggest focus on the core business, oil and gas, that does not mean that the oil and gas industry cannot invest in some projects. For example, biofuels actually make sense, for example, for Petrobras in Brazil, where gasoline has 27% ethanol, and ethanol is very competitive in Brazil, although not in other countries. So here, for example, it might make sense for Petrobras, certainly in its refineries, it's investing in making those mixes competitive and so on. And maybe other countries, maybe in Southeast Asia, maybe in Africa, that might be the case.
But the profits with ethanol are so low
Exactly.
compared to oil.
That's why the core business
It's not for
has to be there.
Petrobras. It's
Yeah.
not for Petrobras, for other companies.
And maybe for other countries. There are instances where it can be competitive, but in general, your internal rates of return on projects in oil and gas on good projects are way above the renewables. And the oil and gas companies are discovering that. Well, we knew that all along, but all of a sudden they say, gee, we can only make 5-7%, and we can make 15 on the oil and gas. Hey, that's true. So that's the way to go.
The final conclusion could be long life to oil industry.
It will have a long life.
Thank you so much, Professor Cleveland.
It was
It was a
good,
pleasure.
Kabayan.
Yeah.
Take
Thank you.
care.
Take care. Bye bye.